The American school system requires students to take 4 years of English, 4 years of math, and multiple years of science and history. It does not require a single semester of personal finance. Not one. The result is that most Americans enter adulthood with no framework for understanding how money actually works, how wealth is built, or how the financial decisions they make in their 20s and 30s compound into outcomes they will live with for decades. In the next 8 minutes, you're going to get the framework that school never gave you, the core concepts that separate households that build wealth from households that pass money through. This is the Vault Keeper. Let me start with the single most important financial concept most Americans have never been taught explicitly. Concept 1. Your net worth is your real financial score, not your income, not your account balance, your net worth. Net worth is the simplest and most important number in your financial life. Total assets minus total liabilities. Everything you own minus everything you owe. Your home equity, your retirement accounts, your investment accounts, your savings, your car value, minus your mortgage balance, your student loans, your car loan, your credit card balances. The resulting number is your actual financial position. Why does this matter? Because income without net worth tracking produces a dangerous illusion. A household earning $120,000 per year that spends $125,000 per year has a negative net worth trajectory. A household earning $60,000 per year that spends $48,000 per year has a growing net worth. The paycheck is not the score. Net worth is the score. Nearly 75% of Americans fell short of their saving and spending goals last year, according to a Vanguard report. The primary reason is not lack of effort. It is lack of measurement. You cannot improve what you do not track. And most Americans track their checking account balance, which tells them almost nothing about their actual financial health, rather than their net worth, which tells them everything. The practical step is simple. Calculate your net worth today. Write down every asset and every liability. The number you get is your starting point. Measure it again in 90 days. If it went up, you are moving in the right direction. If it went down, you need to understand why. Tracking net worth monthly, which takes about 10 minutes with a free tool like Personal Capital, transforms your relationship with money because it gives you the real measurement instead of the misleading one. Concept 2. The 50-30-20 budget framework, the simplest system that actually works. Most Americans have no explicit budget framework. They track spending loosely or not at all and wonder why money disappears without a clear accounting of where it went. The 50-30-20 framework is the most widely recommended starting point because it is simple enough to actually use. After-tax income splits into 3 categories: 50% to needs, rent or mortgage, utilities, groceries, transportation, insurance, minimum debt payments, the things you must pay every month regardless. 30% to wants, dining out, entertainment, subscriptions, travel, non-essential shopping, the things that improve your quality of life but are not required. 20% to financial goals, savings, debt payoff above minimums, retirement contributions, emergency fund building. The 20% going to financial goals is the category that builds wealth over time. The 50% going to needs is the category that most households must work to reduce in order to free up the 20%. And the 30% going to wants is where lifestyle inflation typically occurs, the category that expands to consume every income increase, if not actively managed. Personal finance is 20% head knowledge and 80% behavior. Lifestyle creep, the tendency to spend more as you earn more, is the biggest enemy of wealth. To combat it, you must shift your mindset from what can I afford to buy to how much of this income can I keep. Bangor Daily News. The practical step. Write down your after-tax monthly income. Calculate 50%, 30%, and 20% of that number. Compare your actual spending in each category to those targets. The gaps between where your money is actually going and where this framework suggests it should go tell you exactly where to focus your financial attention first. Concept 3. Compound interest, the most powerful force in personal finance working in both directions. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether or not he actually said it, the math is undeniable. Here is the investing direction. A 25-year-old who invests $300 per month in a low-cost index fund, earning 7% annually, will have approximately $815,000 by age 65. The same person starting at 35 instead of 25, same $300 per month, same 7% return, ends up with approximately $379,000 by age 65. The 10-year head start is worth approximately $436,000. Not because of $36,000 in additional contributions over 10 years, because compound interest had 10 more years to work. That is the investing direction. Here is the debt direction. A $7,286 credit card balance, the average balance for American card holders carrying debt, at 20% APR with only minimum payments, takes approximately 25 years to pay off and costs approximately $15,000 in total interest. You pay back nearly 3 times the original amount, not because you bought anything else, because compound interest at 20% had 25 years to work against you. The practical implication is direct. Every dollar you carry in high-interest debt is compound interest, working powerfully against you. Every dollar you invest consistently over long periods is compound interest working powerfully for you. The household that eliminates high-interest debt and redirects those payments into investments is essentially flipping compound interest from enemy to ally. Over a 30-year period, that flip can mean the difference between retiring comfortably and retiring with nothing. Concept 4. Your credit score is a financial tool, not a report card. Most Americans think of their credit score as a judgment of their financial behavior. It is actually a financial tool that directly affects the cost of almost every major purchase they will ever make. A credit score of 760 or above versus a score of 650 on a $350,000 30-year mortgage can mean a difference of approximately 1 to 1.5 percentage points in interest rate. On a $350,000 mortgage, that rate difference costs approximately $65,000 to $100,000 in additional interest over the life of the loan. That is not a small number. It is the difference between 2 financial lives that start with the same home purchase. Pay bills on time every month without exception. Payment history is approximately 35% of your FICO score and the single most important factor. Keep credit utilization below 30% of your total available credit. Utilization is approximately 30% of your score. Do not open multiple new credit accounts in a short period. Check your credit report annually at annualcreditreport.com, the only federally mandated free credit report site, and dispute any errors immediately. Errors on credit reports are more common than most people realize, and a single error can cost you thousands of dollars in higher interest rates on every loan you take for years. Concept 5. The difference between assets and liabilities, the foundation of wealth building. Robert Kiyosaki popularized this distinction in Rich Dad, Poor Dad, and despite the book's age, the core concept remains the most useful financial framework for ordinary households. An asset puts money in your pocket. A liability takes money out of your pocket. A rental property that generates positive cash flow after all expenses is an asset. A home you live in that requires mortgage payments, property taxes, insurance, and maintenance while you live there is technically a liability in cash flow terms, even if it appreciates in value over time. A stock portfolio that pays dividends is an asset. A car loan that requires monthly payments on a depreciating vehicle is a liability. A business that generates income while you sleep is an asset. Student loan debt that requires monthly payments regardless of your income level is a liability. This framework does not mean you should never own a home or go to college. It means you should be honest about which things in your financial life are generating cash flow toward you and which things are requiring cash flow from you. And it means that building wealth requires deliberately acquiring more assets relative to liabilities over time. The most accessible assets for ordinary Americans are retirement accounts invested in low-cost index funds and high-yield savings accounts. These require no special knowledge, no large initial capital, and no ongoing management beyond periodic rebalancing. They are the foundation of every wealth-building plan that actually works for ordinary households. Concept 6. The tax code rewards specific financial behaviors. The United States tax code contains some of the most powerful wealth-building tools available to ordinary Americans, and most people never use them because nobody explained that they exist. The 401k allows you to contribute up to $24,500 per year in 2026 on a pre-tax basis. That contribution reduces your taxable income in the year you make it. If you're in the 22% federal tax bracket, a $10,000 401k contribution reduces your federal tax bill by $2,200. The money then grows tax-deferred until retirement. The Roth IRA allows you to contribute up to $7,500 per year in 2026 on an after-tax basis. The money grows completely tax-free, and all withdrawals in retirement are tax-free. On $7,500 per year, growing at 7% for 30 years, the tax-free advantage over a taxable account is approximately $350,000 in additional wealth. The health savings account allows families to contribute up to $8,150 per year in 2026 with a triple tax advantage. Tax deduction on contributions, tax-free growth, tax-free withdrawals for qualified medical expenses. Money not used for medical expenses becomes available penalty-free at age 65 and functions as a traditional IRA, taxed as ordinary income when withdrawn. The mortgage interest deduction allows homeowners to deduct the interest paid on their mortgage from their federal taxable income up to $750,000 of mortgage debt. Capital gains tax rates on investments held longer than 1 year are significantly lower than ordinary income tax rates, 0%, 15%, or 20%, depending on your income level. This means the tax code explicitly rewards patient long-term investing over short-term trading. None of these tools requires wealth or sophistication to use. They require knowing they exist and making the enrollment decisions that activate them. The household that uses all of these tools consistently over a working lifetime will accumulate hundreds of thousands of dollars more in after-tax wealth than the household earning the same income that never learned these tools existed. Now let me give you the framework in practice, the 6-step sequence that applies all of these concepts. Step 1. Calculate your net worth today. Total assets minus total liabilities. This is your starting point and your real financial scoreboard. Step 2. Apply the 50-30-20 framework to your after-tax income. Identify specifically where your current spending differs from the targets. The gaps are your action items. Step 3. Eliminate high-interest debt using the avalanche method. Highest interest rate first, regardless of balance size. Every dollar applied to 20% credit card debt generates a 20% guaranteed return. Step 4. Build a 3-month emergency fund in a high-yield savings account paying between 4% and 5% APY. This eliminates the financial fragility that forces the worst financial decisions. Step 5. Capture your full 401k employer match. Then maximize your Roth IRA. Then consider an HSA if you are on a high-deductible health plan. These 3 accounts in sequence represent the optimal tax advantage structure for most American households. Step 6. Invest the remainder in low-cost index funds. Automate contributions. Rebalance annually. Do not watch daily fluctuations. Mastering your money is not about earning a 6-figure salary or being a financial genius. It is about building small, smart habits that compound into long-term wealth, freedom, and peace of mind. Bangor Daily News. That is the complete framework, not complex, not reserved for the wealthy or the financially trained, built on 6 concepts that should be taught in every American high school and are not. Drop a comment below. What is the one financial concept you wish you had learned earlier in life? I read every comment and respond to every question directly. Tell us what state you are watching from. Subscribe to the Vault Keeper newsletter for daily financial intelligence before markets open. Every morning, before the session starts, you get the information that matters in plain language with clear implications for your financial decisions. Link is in the description below. Subscribe. Turn on notifications. Data before price. The Vault Keeper.